Good morning, guys. I'm just going to give the other attendees a few seconds to enter the room. It's cool to see some familiar names here. Excellent. Hi, Rafael. I think that's how you pronounce your name. I'm sorry if I've pronounced it incorrectly. Good morning. Okay, guys, let's get this underway. So look, again, good morning or afternoon or evening from wherever you're joining us. From the FP Markets team, thanks so much for joining us today. As I can see here, we have a reasonably good turnout with some regulars. So for those of you who don't know me, my name's Aaron Hill, and I work with FP Markets in the research department. So before I begin the presentation, I hope we all can see the welcome slides nice and clearly, and you can hear me loud and clear. If not, do let me know in the chat box, and we'll try and get things up and running for you. So look, as I highlight in every webinar, a recording of this presentation will be available through a number of avenues. Now, the easiest way to locate a previous webinar recording is through the FP Markets website. Now, guys, just check the for resources on the upper menu and on the main web page. And under the education column, you'll find the webinars tab. Otherwise, you can also check out the FP Markets YouTube channel, or simply just wait for FP support to send out an email on how to view the recording. Thank you, Rafael, for confirming that. Excellent. So look, as in every single webinar we give, I have to run through this disclaimer just really briefly. So the information contained in this material is intended for general advice only. Look, it does not take into account your investment objectives, financial situation, or particular needs. So look, FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. So the essentials of this disclaimer is really there to highlight that anything discussed here is not investment advice. It's simply educational. And as I always recommend, you should always conduct your own research in anything trading and investing, as ultimately it is you who pulls the trigger at the end of the day. Now, for anyone that doesn't know who I am, just a quick intro. So we all know who's behind the mic. As I've said, my name's Aaron Hill. I'm the technical analyst for FP Markets. I have more than 12 years experience in the financial markets. I'm learning every single day, guys. That it's a never-ending learning curve in the financial markets. So if you ever meet anyone that says they know everything about finance, I'm pretty sure they're lying. So look, it's a never-ending learning curve as far as I've experienced anyway. I also recently completed the CMT program, and on the back of that, I also received the CFTe qualification. In terms of my trading, I'm a big fan of price action, Fibonacci. For anyone that follows my daily market analysis or the weekly market update, you'll note that price action, Fibonacci, the relative strength index, and also chart psychology are the main components of my trading. Okay, swiftly moving on. So as you can see, we have a number of topics to get through in today's session, kicking off with an introduction to chart patterns, flag and pennant formations, wedge configurations, head and shoulders pattern, excuse me, triangles, and finally, look, if there's room, we'll open the floor up to questions. One thing I will highlight during this presentation is that everything I show is what I consider to be textbook, meaning the patterns identification standards and measures are taken from well-known authors. However, I know from experience that traders adapt pattern arrangements to suit their trading methodology, which is absolutely fine, as trading, at least in my experience, is shall we say, a subjective art. So whenever I switch from what I believe to be textbook to my own personal views, I'll try to remember to underline this as we go. Also, please feel free to share your views on the patterns shown in the chat box, and we can have a discussion about that. One other thing worth pointing out is that although we all should keep our own records of pattern success rates, a gentleman by the name of Thomas Bukowski, I think that's how you pronounce his name, has done considerable work on this. So be sure to check out his content. He runs a website called the Pattern Site, and also has a book titled A Visual Guide to Chart Patterns. Now, if memory serves me correct, his work states that a tight bullish flag and the head and shoulders top are some of the best performing patterns. And look, these are not small tests he did. These are not small sample sizes he conducted the tests over. I believe they cover something like 3,000 examples. So look, without further ado, let's get this underway. So an introduction to chart patterns. The terms pattern and formation are often used interchangeably, which is something I'm also guilty of. I also sometimes use the word configuration as well. Right, what are chart patterns, and are they a means of successfully navigating markets on a consistent basis? Depending on who you ask, each answer will be slightly different. So depending on their experience level within the markets. Now, I'm sure most of us have heard that patterns don't exist on the charts. That price is random and has no structure. Now, this is largely the opinion of many academics, as far as I'm aware. So really, guys, for me, I have found patterns do form in the markets, and these, again, as far as my experience goes, are formed on the back of traders' emotions. This is not only down to my own personal experiences, but also traders I am in contact with who use pattern structure to generate trading decisions. But ultimately, look, it is down to you to decide and prove for yourself whether these patterns are, shall we say, real or not. What I mean by this is you will need to conduct thorough backtesting. And I'm not referring to 10 trade examples. You should ideally target much more than this, which, ultimately encompasses all market environments. So bull, bear markets, ranging markets, and things like that. Now, I have read some traders accept 20 to 30 trade samples in a bag test. I guess if you're trading the daily time frame, this may be sufficient, but for me, especially on the lower time frames, I want at least 50 to 100 on each, 50 to 100 pattern samples on each pattern. That likely catch more of the trading environment, as many trading environments as possible. I've also been told on a number of occasions that that it's not the technical patterns that generally causes failure in this business. It is the trader. Chart patterns present themselves and will offer similar characteristics to the preceding patterns developed, but the outcome will be random, which remains a difficult piece of the puzzle for many traders to understand. However, over a series of trades, there is usually predictability. Now, for anyone that follows or has read the book written by Mark Douglas, the late Mark Douglas, on trading in the zone, this will likely ring a few bells for you. So he really emphasizes this point that each individual trade has a 50-50 chance of winning. It's over a series of trades. There's usually predictability in the form of an edge. So look, and look, this is where thinking in probabilities comes in handy. Right. So for those interested in dipping their toe in the world of psychology, we had a presentation on this some time back, which is available on the main FP Markets webpage, or again, look throughout our YouTube channel. One final point before I move on from this slide, which may be obvious to those who've been in the market for a while, is patterns are formed. Just bear with me, guys. Okay, right. So yes, the patterns are formed by way of horizontal and excuse me, and ascending and descending lines. For any newer traders confused by this, hopefully in the next 30 or 40 minutes, this will become a lot clearer. Right, on the first slide, we have flags and pennant formations. Now, I'm sure you guys have seen other traders use flag and pennant patterns in forums and across social media channels, and likely for good reason. These formations are considered high probability patterns and offer frequent opportunity. Now, flags and pennants, as you can see, are similar in structure, and they offer relatively short and offering relatively short-term structure. So, the majority of textbooks I've come across states that these patterns are generally shorter than 3 weeks in duration. However, myself and other traders do employ these patterns on much shorter time periods, like the H4, H1, and lower time frames, which, as I'm sure you can understand, will fall considerably short of that 3-week duration limit. I think the majority of the textbook definitions assume most of us trade the daily time frames and higher. But again, guys, look, feel free to test this for yourself and prove whether these formations are, shall we say, a fit for you on the lower time frames. Now, as you can see from the slide, both flags and pennant patterns show what's just trying to find my cursor. Sorry, guys, just bear with me. Okay, just bear with me. Pen out. So as you can see, the bullish flag and bullish pennant both contain what's known as bullish and bearish flags and pennants all contain what's known as a pole. Look, but it's really, the name really isn't anything to be concerned about. The key thing to note is that patterns are accompanied by a distinct up move in a bullish formation and a distinct down move in a bearish formation. So what is a pole? Well, a pole is essentially a strong run, either higher, as you can see, or for a bullish arrangement, as I've said, or lower for a bearish scenario. This, guys, this really is an important yet often overlooked element. Do not regard this point. I've seen countless traders highlight the fact that they think they're watching a bullish flag unfold, when really they're not, because they haven't accounted for the pole that precedes the formation of the pattern. So, in fact, a good method to begin looking for these patterns is to start by looking for the pole first. What you'll see on charts is often a strong move to the upside or a strong move to the downside, which can be composed of a number of candles. It doesn't have to be just one candle. Yes, so this is very important. Another point, of course, to take on board is that flags or pennants should look proportional to the height of the flag. So ask yourself, right, so look, let me just repeat this. Another point to take on board is that flags and pennants should look, proportional to the height of the flag. So look, really, ask yourself whether the flag is too big or too small for the flagpole. So here, as you can see, it's pretty much, you could even say this is too big for this flagpole here. Ideally, you'd want a nice tight bullish flag here and a resumption to the upside. Now, this is ideal. This will take some time to get used to, I would imagine, on the charts, but this is ideal. These are ideal, these pennant formations. Okay, so the key point to note, of course, is to make sure that they are proportional to the flags, the pole that precedes the pattern's formation. Look, for flags, let's just get rid of these drawings. Okay, so for flags, the pattern's makeup is simply formed by way of two reasonably parallel, as you can see, parallel ascending or descending lines with at least two contact points required on either side. Other traders, however, may require more tests to confirm the flag. So let me just demonstrate this. So we have point of contact 1, point of contact 2, point of contact 1, and point of contact 2. So we've got 2 points of contact on either side of the flag. As you can see, the lines are parallel. The lines are parallel. And generally what you'll find with the flags is that they tend to form against the prevailing move. So the flagpole is higher. You'll find that the flag is generally against the prevailing up move or down move, depending on what flag you're looking for. Now for pennants, we look at two converging ascending or descending lines. Now, as you can see on the slide, which forms a tight triangle formation. Okay. I generally look for the tight formations. How far do we want to see these patterns retrace against the prevailing trend? Now, this is a very, very good question. So how far, and this can help determine the size and in terms of the size of the flag in terms of the pole. But look, let's focus on the pennants for now. But so for me, what I do is I often take the Fibonacci retracement tool, and I start from point, just say point X to point A to the upper side of the pennant formation, and just simply extend the Fibonacci retracement tool. And I want to see the 38.2. Oh, sorry guys, 38.2% remain intact. Ideally, I don't really want to see a 50% move, because then we're looking at something like this, right? So this is more of a 50% move at this point here. So I look for the 38.2%. So I like to see my pennants form above, for a bullish pennant, above the 38.2%, and obviously below the 38.2% for a bearish pennant. Now, look, importantly, flags and pennants can essentially slope in either direction. Now, it's very important to take this into consideration, because we can easily disregard some of the pattern structure. So some patterns because of this. Yet the most common pattern structure we'll see will be leaning against the price trend, as I explained here. So it's leaning against the overall trend to the upside, leaning against. So we got a downtrend there, and we're leaning against that. These patterns are also typically viewed as continuation patterns within the prevailing trend. Also, for traders who use volume studies, those who trade in the futures markets and stock markets, for example, may want to note that volume tends to decline as the pattern forms. So you'll usually see a decline in volume, okay? Though a spike in volume can sometimes be seen on the breakout of the pattern, okay? So the breakout point, right. So let's just touch on volume for a minute. Look, absent of a primary exchange, just bear with me, I think we've got some questions. Okay, a question from Alan. Is the pattern applicable to the Heikin-Nishi candle? Look, Alan, I have to be totally honest with you. I've never traded the Heikin-Nishi candles or anything. I wouldn't even know how to explain that. So I can't really answer that question. I would assume so, to be quite honest, but I tend to stick to the basic time series charts. We have a question from Andrew. As an example, if the daily flag looks heavy for the pole, saying a long, is this a good time to look for a short Quasimodo? I love the fact that you're using Quasimodo. That's fantastic on the daily. So if a daily flag, let me just try and read this question. If a daily flag looks heavy for the pole. I'm not sure what you mean by that. If a daily flag looks heavy for the pole, saying along. So I assume you mean a strong upside move. Is this a good time to look for a short Quasimodo on the daily or H4? You know, it's a good question, but I'm not too sure. I think what you're saying is, if you get a strong move to the upside, is it a good chance? Is it a good time to be looking for shorts at a Quasimodo level? For me personally, yes, it is. As long as you've broken some structure on the way, taking out some stops on the way. Don't just you need to see some context with your trade. I hope I answer that fully for you, Andrew. Mark, so a question from Mark: how many moves are required within the flag or pennant to validate a pennant or flag formation? So how many moves do you mean contact points? So for me, and this is textbook, guys, we need 2 points of contact. Okay, so I'm circling these now. Ignore this one. This is the breakout point. So we need 2 points of contact. But look, Mark, if you have, the more the better, in my opinion. If you have something like this, if you see price, a nice strong, so the textbooks say a 45 degree is that's not even 45 degrees, it's something like that. Okay, so and then we have price forming a nice tight bullish flag like this. You have seen them. I'll guarantee most of you have seen these patterns, and they break out lovely to the upside. So this is ideally what we're looking for, a nice tight formation. So as you can see here, we have around 3 points of contact on either side, right? So that the 2 points of contact are the minimum, if that makes sense, are the minimum. I would always look for more. I would always look for as tight as possible, to be quite honest. So, okay, so let me crack on with this. So look, basically touching on volume. So look, absent of a primary exchange or clearinghouse, measuring real-time foreign exchange volume is, it's impossible. Unlike other financial markets, such as the stock markets and futures markets, and also options markets, the foreign exchange market is decentralized, often referred to as an over-the-counter market. OTC is an off-exchange transaction between 2 parties, guys. So volume data on most MetaTrader 4 and MetaTrader 5 platforms are generally broker-fed. The trading activity of so basically this is the trading activity of the broker's clients and not of the entire Forex market. This is important to understand. So this can cause different volume readings across different FX brokers, of course. So look, in the stock market, volume is a measure of how many shares have actually been traded. In the futures market, volume is calculated via the number of contracts bought or sold. The Forex market is different. Although retail speculators would expect volume to represent the number of lots traded, of course, the majority of CFD and Forex brokers actually only display tick volume, which measures the number of times price moves up and down. So what you can think of when this is not the number of transactions, guys. I've got to be careful here because I don't want to confuse, but it's so to take out the above offer. So if we have say the euro trading at 120, yeah, let's say 120, and we're looking to take out 120.01. We're looking to move up a pip. So to move up above this, to take out all the offers at this point, it may take a number of transactions, right? So one tick to the upside may take 100 transactions. It may take 1,000 transactions. We can never know. But one tick, once we've removed, but look, we're normally working in points at this point here, so we would need to see price would move up in points at that point. So that's the 5th decimal value. So we'd move up 1. That's 1 tick. But that could take 4 or 5 transactions, or 400 or 500 transactions, depending on how liquid the market is. I hope that makes sense, guys. Sorry for diverging somewhat. So let's head back to the patterns right now. So look, one final note on the flag and pennant patterns is that the take profit target, of course. The price target for both is sometimes called the measured rule. And this involves taking the distance from the beginning of the flagpole. Let me just remove these drawings. So this involves taking, as you can see from this red line here, involves taking the distance from the beginning of the flagpole to the to the upper range of the pattern where the first rotation lower was seen. So we take this value and simply extend that from this point here to reach the flag target. And we do the same with the pennant, okay? And it's the same for the bearish formations as well. Pretty simple, really, when you think about it. But now, guys, look, I'm sure you can spot the mistake I have made on this slide. I did not extend the length of the pole from the breakout point. I actually extended it from here, so that should have been much higher. I apologize for this if I've caused confusion, but let me know if I have, and I'll go over this part again, no problem. Look, one other point worth acknowledging is flags and pennants are also known as, you'll find this in the textbooks, known as half-staff, staff, I believe they're called, patterns, or half-mast patterns, meaning they sometimes appear midway in a price trend. You can therefore project the price where the trend could potentially end. Now, I'm not one for trying to predict or forecast tops in markets, but look, this pattern says it can help project potential tops and bottoms. Look, it does not always work, of course, but flags and pennants are very, very handy when you need to determine a trend's lifetime, or in your analysis, of course. So look, okay, as time is of the essence, we still have a lot to go through. Okay. Let me spin things over to the wedge. I believe the wedge is next. Yeah, wedge patterns. Okay. And I'll try to keep this session a little shorter. So, right. Wedge configurations. So I'm guessing some of us going by this slide are wondering what the difference is between the wedge pattern and, of course, the pennant formation. Now, if you remember, the pennant formation is simply a triangle made up of converging trend lines, okay? But the wedge is also made up of converging trend lines. The key difference for me is, unlike a pennant pattern, a sharp move preceding the wedge is not required. Remember, for the pennant patterns, a sharp move to the upside and a sharp move to the downside for the bearish formation is required. Another point is that the wedge formation tends to be more of a longer term pattern, whereas a pennant is typically more shorter term. Now, Thomas Bukowski, the gentleman I mentioned at the beginning, actually states on his website, now please do check that out, that the wedge pattern's duration is a minimum 3 weeks. Otherwise, it's a pennant. Okay, so that's very key to recognize there if you're trading, especially if you're trading the daily timeframes. He also underlines that the pattern requires 5 points of contact to be valid. That is 3 points on the trend line, as you can see here, 3 points on the trend line at this point. And look, we have more than, and usually 2 points to the upside, but look, we have plenty here. So we have 3 points of contact here, 1, 2, 3, 4 to the upside, plenty. As long as you have more than 5 or a minimum of 5 points of contact, you're good to go. Actually, many experienced traders simply see the wedge as more of a channel, but just a converging channel, if you will. Look, wedges are also a pattern that can form in the shape of in a consolidation against the prevailing trend, and also as topping and bottoming formations, i.e. reversal structure. Look, again, guys, we do not require a pole to precede the wedge formation. That is key. So, for example, here we have a rising wedge, a rising wedge formed within an uptrend, right? And buyers are clearly beginning to lose steam. So what do you think the RSIs and the MACDs will be doing once price is starting to compress like this? So we've had a reasonably dominant uptrend, right? but momentum is clearly slowing. So what generally happens with the RSI, for example, you'll see the RSI start to turn lower, which will probably be in the overbought area. And then you'll start to see things like divergence form. And all that's showing is momentum to the upside is beginning to change gear, if you will. So this brings me to look a vital point. The trend line, the lower ascending line should always have a steeper slope than the opposing channel, as I wrote there, the opposing channel line. Otherwise, I do not see here how this can really be considered a wedge. Look, once or indeed if price breaks the trend line, as we can see here, so a close forms beneath this line. Many traders then look at the above the opposing line for as a logical placement for stop loss orders, protective stop loss orders. So for me, if a supply or resistance is present around this area here, I would probably take that into account as well for stop loss placement. Look, from what I've seen in the books and from other traders, there's really no measuring techniques to estimate the decline to like a profit objective. So look, other aspects, but look, I have seen many traders just take the base of the pattern and then extend that to the downside, which works for many. But look, you can look at other aspects of technical analysis to forecast the price targets. However, many will take the base, or as I've said, the base of the pattern, and they simply extend that to, let me just draw that on so we're all clear on what I mean. So what I mean is they'll take the base of this pattern at this point here, this value, oops, sorry guys, I meant this, rub that out. This point here, they'll take this point and extend this here. Okay, so what you'll see is just an extension of this value here to from the breakout point. So it should have been up there really, but I hope you get the point. And this is the profit objective down there. That's the most common way of doing it. I've not really seen that in many textbooks, to be quite frank with you. But for me personally, I would start looking at the technical structure as well as this profit objective there as well. The pattern also tends to be accompanied with diminished volume as well. So as prices are rising within the wedge, you'll often see volume trickle lower. Look, very similar to the RSI, right? You might see some divergence playing out as prices rising, right? So it's very similar. Right, I hope this has been of use to you guys, this part here, the wedge and the flag and pennants. But I'm trying to get as much information as across as I can. I will now switch to a chart pattern that I'm sure we're all reasonably familiar with, and that's the bear with me. I think that's the head. Trying to clear my drawings. That's the head and shoulders pattern. Write his name, please. Shabu. Are you talking about? You're talking about Thomas Bukowski, I think. Okay, I'll put this in the. I think this is how you spell his. Yeah, it is. So do a search for this guy. I'll put it in the chat box. Do a search for that guy, and his site is called the Pattern Site. Okay, it's a fantastic site, and it'll give you all of the tests he's done and the requirements for his patterns and things like that. It's fantastic it's a fantastic site to visit. So as I've said, this is the head and shoulders is probably one of the most well-known chart patterns today, with the likes of, as I said, Bukowski stating its statistical significance as one of the better performing patterns, with more than 50% of the time price reaching its target, if memory serves me correct. And this, again, guys, look, this was really done over 3,000 trade samples. This wasn't a small trade sample. This wasn't 100 trades. This wasn't 1,000 trades. It's 3,000 trades. So look, the head and shoulders top and bottom patterns are relatively, they're relatively complex, especially for newer traders, and can be confusing. So hopefully I can be of help here. Just as a quick heads up though, the head and shoulders bottom is actually called an inverted head and shoulders, as you can see here. This is an inverted head and shoulders pattern, and this is a head and shoulders top. Okay. Now, the head and shoulders is considered reversal structure, which means it, shall we say, forecasts points on a chart. A preceding up or down move may reverse. It does not necessarily have to form within a monstrous up or down trend. It could simply form within a retracement or, a pullback within the prevailing trend, and mark an entry into that trend to buy a dip or even sell rallies. So the pattern consists of 3 peaks. Okay, that's pretty self-explanatory. 3 peaks for the head and shoulders top. Let me just get the pen out, it's easier. So 3 peaks for the head and shoulder top, go, and 3 troughs for the head and shoulder, the inverted head and shoulders. Now, the first peak is called, as you can see, the left shoulder, okay? The first peak is called the left shoulder, followed by a subsequent higher high, and this is the head, and then another right shoulder forms following this. Note that the pullback to form the right shoulder at this point here does not break the recently formed head. So what I'm trying to say is, the pullback here does not extend past the head point. Okay, that's very, very important. If it does, it invalidates the pattern structure. Right, so although not often seen on the charts, the 2 shoulders are best seen at approximately equal levels. Okay, again, let me just repeat this. Although not often seen on the charts, the 2 shoulders are best seen as symmetrical and equal levels. Okay. Now, of course, this does not mean this does not have to be perfection here, guys. It's just a point to be aware of. I also look for symmetry to form with the 2 shoulders. So both should really emphasize either a wide or narrow presence, right? So if this is a relatively wide left shoulder, I would want to see the same really on the right shoulder as well. Okay, so I hope that makes sense. Another thing, feature worth highlighting, is what's known as a complex head and shoulders top or inverted head and shoulders bottom pattern. Now, in these scenarios, these include patterns with, say, let me just draw this out. So we have the left shoulder forming here, but we also have another left shoulder here, and then we have the head, and then we have, say, the right shoulder here. Now, these are really called just complex head and shoulders patterns. Despite there being a variation, the characteristics remain the same. So you can also have a left shoulder, and then, two tops for the head, and the right shoulder could have just one peak. Okay, so these are called complex. So let me just write that in. Oh, I'm attempting to write that. I'm sorry, guys. I'm writing like a 4-year-old. Just bear with me. Complex. Okay, so look, complex. Right. So when the head and shoulders top is spotted and the neckline is broken. Now, the neckline is very important. It usually signifies that a currency pair is headed lower. So this brings me, of course, nicely onto the neckline. So the neckline for a top is drawn across the bottom trough. So these points here, this point here, and this point here. So you'll have a neckline drawn across here. And then once price breaks through that neckline, not breaks, closes below the neckline, we then have a bearish signal. So when or indeed if price breaks through the neckline after forming the right shoulder, of course, it indicates the conformation of the head and shoulders top. Now, for top formations, it is best to see the neckline either in an ascending position. So let me just draw this very quickly here. Oh, that's not great. Okay, so we've got a mildly ascending neckline. So it's ascending, okay? And then we get a break to the downside, or as we see here in a horizontal form. We don't really want to see a, yes, I'll get to that in a minute. Just bear with me. So look, while for an inverted example, either a descending neckline. So let me just draw this very quickly. So we have the left shoulder, the head, and then we have the left shoulder here. Yes, there we go. And there we have the descending neckline. Sorry, guys, I should have touched that point there. But look, we get the breakout to the upside there. And look, ideally, we want it either in a descending motion or a horizontal motion, as we see here for the neckline, that is, guys. Now, why do we want it like that? So look, the entry trigger for a head and shoulders is a close beneath or above the neckline. So some traders may opt to wait for additional confirmation in the form of a retest of the neckline. So price breaks down, retest the neckline, and continues lower. But look, so what we don't want to see, what we do not want to see, is a head and shoulders, say top, form with a trough formed at that point, and then look at this is why we don't want to see a descending neckline within the head and shoulders top, or an ascending neckline within an inverted head and shoulders, because look, it would take price a lot longer to give you the entry signal, the sell entry signal. And where would you place your stop? Your stop would be huge. If it's above the head, it would be humongous, right? Or even above the right shoulder, it's still going to be huge. Ideally, you want them to be facing, as I said, in an ascending for the top formation. So you can place your stop nicely above the right shoulder, or for the inverted panel, the inverted structure, head and shoulders, you want to place your entry here and then place your stop below the right shoulder. As for volume, guys, look, the patterns, let me just get rid of all of this. So as for the pattern's price target, the textbook approach is to measure from the height from the head of the neck, from the head to the neckline in a vertical fashion, and quite simply add this to the breakout point. So we measure from this point to the, I hope you can see this, guys, to the neckline, and then we simply extend this value here, extended from the breakout point, okay? And that's it. That's all we do. As for volume, for anyone that follows the volume studies, this tends to be highest on the left shoulder. So volume tends to be highest on the left shoulder, and then as the pattern subsequently develops, volume tends to decline, okay? But it is always nice to see a volume increase on the breakout point of the neckline. Okay, so let me just check. I think we have some questions. Just bear with me. So Daniel, have I done wedges? Yes, I have. I apologize. I did them at the beginning of the presentation. Mark, do both shoulders have to be the same height? No, they don't. But look, as I said, both shoulders, I assume you're talking about the head and shoulders. Yes, you are, yeah. So look, the left shoulder and right shoulder in this drawing are symmetrical, right? So I just look for as symmetrical as possible. But look, in the markets, we're not always going to get that. You have to be realistic. So I look for as good as possible. What I don't want to see is my left shoulder down here and my right shoulder up by the head. I really just do not want to see that. That's just my personal opinion, guys. This is not really something that's, I mean, in the textbooks, you're going to get near perfect examples like this. But for me, I just look for as good as I possibly can on the charts. Okay. Right. Okay. Triangle patterns. Right. So just bear with me. So a number of pattern structures fall under the umbrella of triangles, including the standard triangle, i.e. symmetrical triangles, ascending or descending triangles, as you can see on the chart, on the slide. The wedge and pennant formations are also triangle formations, which we've already looked at. The broadening pattern, that's, let me just draw that on because it's quite a funky pattern. Just let me draw that on. So the broadening pattern, it comes out like this. Think of it as like a megaphone. It's a nightmare to trade. I wouldn't recommend trying to trade this, but this is another one. Can you see? And then we get a breakout to the downside. Where you would place your stop loss, I have no idea in this case, but this is a broadening pattern. But what this can lead to is something called, I'm going a bit off from notes here, but this can also lead to what's known as a diamond formation, okay? And which sees this happen. Now, these are very high probability patterns, diamond formation. These form at tops and bottoms. Now, if you get a breakout to the downside so all it is, guys, really is a broadening formation coupled with a symmetrical triangle. And if you get a breakout to the downside at a top, the move can be quite dominant, if you will. Anyway, let me just get that off there. I may have touched this on the note in my notes. I'm not sure. Just bear with me. So look, for the purpose of this presentation, the focus will largely be on the symmetrical triangle, the ascending triangle, and of course the descending triangle. So let's kick things off with what's known as a symmetrical triangle. Although you would expect this formation to have symmetrical sides, it rarely does. And that's why many textbooks also label this as a coil. Now, let me just write that in, a coil, okay? As price essentially coils within converging limits. And as I've just mentioned, these converging limits are seldom symmetrical. Within the pattern, price action must touch the lines at least twice. So as you can see, 1, 1, 2, 1, 2. So here we've got more. As I said, we always look for more. The minimum is 2. Similar to what you would say with a trend line to activate its presence, of course. So look, we also want to see price action cover the triangle space. So as you can see here, let me just remove those points. As you can see here, the price action really does a good job of filling in the symmetrical triangle, right? So it's the same for our pennant formations and our flag formations. As you may remember, I drew those formations, and I wanted to see a nice tight formation form. I don't want to see this, that, you know, that it's just not for me. Some traders will take that as a bullish flag, but for me, no. I like to see a nice, compact, clear area that's obviously forming a flag pattern. And remember, guys, I always look for the 38.2%. If it's, look at the size of this flag compared to the pole, look at the size of this flag compared to the pole. It has to be proportionate to the pole, if you remember. Right, so I look for at least 60 to 90% of the space to be covered within the pattern before considering it valid. In fact, I read, I think it's the Edwards and McGee book of technical analysis, that most of the best breakouts of the coil triangle occurs at around 75% from the base. So the base is this. Remember, the base is this point here. This is the base. So 75%. So 75% is around here. So most of the best breakouts, according to those authors, occurs around the 75% point. How much you should allow this to influence your decisions is totally up to you. But I would always recommend doing my own back testing before coming to any conclusions, especially when you have live money on the table, guys. Though look, it is important to note that false and premature breakouts are also common, very, very common within pattern structures, as I'm sure you've seen. So be sure to have some filter if you're considering these patterns to determine breakouts. So what I mean by filter is you could use the close filter. You could wait for price to close above. You could also wait for price to retest the area. You could also have a time-based filter. So you would want to see, if you're trading a daily chart, you would want to see price close above here for at least 3 days before taking a position. You could also use the moving average. So if you're using, say, the 30-day moving average for the daily time frame, you want to see price come above the 30-day MA before taking a position in this market. Right. So as for volume, this tends to decline during the formation of this pattern. For the price target, traders often estimate the extent of the move after the breakout by measuring the widest distance, the base, and simply applying this to the breakout point, very similar to the other triangle patterns. Textbooks show we should see a buy or sell on higher volume. Again, though, look, some traders prefer to wait for a pullback, as I've shown there. Some traders or a retracement to form. Look, as for stops, traders tend to look beyond structure, but I would always recommend looking at surrounding technical structure. So what I mean by that is traders would enter long here and place stops below here. But look, guys, if you have a clear-cut area of support at this point here, always place your stop below there. There's just little point in placing it there because there's a good chance that price will potentially whipsaw below that. Below into that support to gather more buyers and take out any weak hands that have placed their stops too close. So yes, I would always recommend looking at surrounding structure for placing your protective stop loss. Most symmetrical triangles should be no longer than 3 weeks, and this is again on the daily time frame, guys, to help distinguish them from pennants. So should be longer than 3 weeks. Again, guys, this is textbook stuff. The exception, of course, is when the pennant is missing a flagpole. In that case, the pennant is really just a small symmetrical triangle. But look, guys, I know we will be looking at these patterns on different time frames that will not reach the 3-week characteristic. Therefore, attention should be paid to the flagpole. So if a triangle lacks a pole, it's likely a wedge configuration. Okay, on to ascending and descending triangles. Right. So as you can see, ascending triangles are wedge-shaped patterns that break out most often to the upside. The triangle can act as a reversal or a continuation of the existing trend. Now, for this formation, we look at the horizontal. We look for a horizontal top and a rising trend line. And again, guys, we do look for 2 tests as a minimum to confirm this pattern. A descending triangle is the same thing, guys. I'm not really going to go over that. It's just a mirror opposite of this. Again, just really quickly, these points, so the horizontal line and the rising ascending line do tend to join in the future. Okay, and this is called, I believe, the apex of the pattern. Okay. Again, according to textbooks, look, the volume in the pattern often recedes and can be especially low the day before the breakout. Right. So price must cross the pattern from side to side, filling the triangle with movement, as I've said in the other patterns. Look, for me, I always look for as you can see here, this is a nicely filled triangle. I always look for a clearly filled triangle pattern that, So in terms of entry and stop loss placement, entry is typically taken on the breakout of the triangle pattern. So at this point here and at this point here, though, like most breakout traders, you may want additional confirmation. So look, in terms of stops, I do see some traders place them just above and below the structure. Look, for me, guys, just do your homework, look at the charts, see what the technical picture is telling you. If you have a support area at this point here, it's very similar to what I said with the symmetrical triangle or the coil. If there's a support there, just place your stop below the coil and factor that into your position sizing. And if the risk reward is not accommodating after doing that, just don't take the trade. It's very, very simple. So yes, as for price targets, textbooks quite simply calculate, again, the base distance and then extend that base distance from the breakout points and a trade as such. Right. Let me just get rid of that. Okay, Q&A, guys. So let me see what questions there are. I believe there's quite a few come through. Right, so Mark, that was cleared. Right, bear with me, Daniel. I can see your question there. Right, okay, we have a question from Musa. I'm sorry if I pronounced your name wrong. So please, which time frame is suitable for trading these patterns? Ken, this really depends on you. If you're a day trader, you'll be looking at the shorter term configurations. But if you're a position trader, someone that trades longer term time frames, but you may be looking at the daily time frame or even weekly time frame. But for me, the daily time frame is a nice time frame for these patterns, I feel. But look, I have traded these on the lower time frames as well. So it just all depends on your time commitments and obligations. Would you say there's a wedge on the S&P 500? Let me just check. Just bear with me. Just trying to find the chart now. On the daily time frame, was that? Just bear with me, guys. You mean a downside? You mean a falling wedge? I would imagine. No, I would not. That's not a wedge for me. That's more of a. Let me just see. I'm just trying to see. No, it's not a wedge. Not for me. Most definitely not. Okay, with the widening patterns, do you get that widening or lower lows and higher lows? Because I'm unsure of what you mean there, Daniel. Can you maybe rewrite that question for me? Mark, question from you. Are the patterns applicable on Forex? Yeah, of course they are. 100% they are. On shorter time frames like the 1 hour to 4 hours. Look, Mark, I traded the the flag and pennant, mainly the flag patterns, to be quite frank, the flag patterns on FX on the H1 time frame. But look, guys, you really should not trade these blindly. You need to look at the overall structure. Let me just draw this on there so it's clear with what I mean. So for instance, if you're trading on the H1 time frame, you see a lovely bullish flag form right at this point here. But because you haven't done your homework, you know there's a daily resistance at this point, a D1 resistance. How far do you think that breakout's going to go? There's a high probability it's going to fail, right? So you always have to do your homework. Always have to do your homework. Now, if the pattern formed on the breakout of the daily resistance, then yes, you have a fantastic setup. So you always have to look at the context before you take a trade. So from Daniel, the question is, megaphone pattern has normally higher highs then followed by lower lows. Yes. Why do you get that? Why do you get that really widening? Is that because of the volume changing or lowering? No, it's just the volatility is expanding. So a broadening pattern is simply this, isn't it? So you're just getting more volatile. I'm not sure, to be quite frank with you, why these form. you know, it's just more of a volatile market, right? So it's a very erratic market. You may see this on the lower time frames, but look, guys, for trading these are an absolute nightmare. So you buy long here. Where would you place your stop unless you were very confident with your structure? Be very it'd be almost impossible to trade, especially if you want to place your stop below the lower edge of the pattern. You've got to have some risk reward to make that worthwhile. Right, so let me just clear those. Right, so look, as I've not really had much time to cover the psychology of these patterns, and there was no time to actually show the actual charts in action. If you guys think it would be worth revisiting this, I'm happy to do this, and we can probably go over this in more in-depth analysis with what I just explained. So if you trade on the H1, you have to be aware of the higher time frames and where you are positioned. Look, so going for, if there is demand for that, please do let me know in the chat box, and we'll try and get something sorted for you guys. So upcoming webinars for the month of June, we have the MACD on the 16th of June at 9 a.m. All at 9 a.m. guys. Here we'll be an introduction to the MACD. We'll be learning how simple the MACD formula really is, MACD strategies, convergence and divergence, and things like that. Quasimodo formation. Now, I saw one of the attendees here mention the Quasimodo pattern, which is fantastic. It's an excellent way of determining support and resistance. So we're going to hit the Quasimodo formations on the 23rd of June and also the 30th of June in a two-part series. So I'll be introducing what the Quasimodo pattern is. I use this daily in my daily markets analysis. I'll show you how to correctly apply the Quasimodo pattern and setups that surround it. Right, so, okay. Look, Val, I'm not sure, I hope that's how you pronounce your name. I don't really have time to look at this chart. What's the LCID chart? Is that cryptocurrency, or? I'm not sure let me just check. Yeah, I'm not sure what you mean. Right. So look, Val, if you want to email me on the either at support@fpmarkets.com or marketanalyst@fpmarkets.com, and I'll happily get back to you with a chart for your request. But look, also, guys, Telegram. Look, please do sign up for our Telegram channel. You'll find that either in the chat box or you can find that at the bottom left-hand corner of the FP Markets website. On that note, guys, I hope this has been beneficial for you. I know I've thrown a lot at you, but a recording will be available. I do encourage you to watch the recording and fire over any questions you may have. Thank you for taking the time out of your day. Have a great session, and I'll catch you on at the next webinar. Thank you so much, guys.